This is Mark coming at you live from the former banking epicenter of the East Coast in the United States. Greetings, traders and investors around the globe. Tonight, I want to briefly touch on a couple things. Got a lot of stuff to talk about in the future in these videos, and I'll go through those in time. But right now, I just want to look at a couple things. The first one is Under Armour, and Under Armour was a blog post on stockpursuit.com not long ago. It followed up after my Netflix post. I shorted Netflix at 116 and covered at 110, and it turned out to be a very good short. The only problem was it went all the way down to the 90s, so I covered a little early. Hopefully, everyone saw that one. I believe that post might have been on that post. Yeah, was on dynamitestocks.com. My other blog. I have two blogs. My first blog is the one I've been doing for a long time, stockpursuit.com, and my other one is where I focus primarily on my trading and short-term trades and charts, stuff like that. That's dynamitestocks.com, and I'll post a link to that in this post in case any of you are interested in that. I'll probably do more videos on that blog going forward, but from time to time I will do a video blog on Stock Pursuit. So right to it, we've got Under Armour that I am short from the 94s. 94.52 I believe was my entry short, and I laid out the fundamentals behind that, which with the volatility like this, and the fundamentals are probably going to weigh a lot on it, like they did Netflix. I mean, Netflix had a 200 PE, which is pretty staggering, even a bull market. So, what we saw was all these stocks with these high PEs, 100, 200, and it became very complacent. When you're complacent with PEs like that, PE is the price to earnings multiple. There's going to be some froth that needs to be consolidated out of that. So I mean, this correction's been very good. I mean, everybody's scared about it because it's because of the swings, date that we had, those 2 days. But I don't want to get into that. But I think it was, it's basically like a flash crash, because I don't remember, at least in my lifetime, that every time you had a correction, there's a flash crash. I mean, really, nowadays the market either goes up or there's a flash crash. I mean, it's really, like we had back back in last year, well, or in 2011, and around that time. So does it bother me? No, because I'm a trader, and that brings opportunity with volatility to make trades. But as an investor, most everyday investors, it's probably a little scary when you see the VIX spike up, just on one correction. Then I don't even know, it may not be done yet. That's why I'm still short here. I'm shorting Under Armour, and to look at the chart of Under Armour, I've got pulled up here. You can see there's this range. There's a range that's been in the past several trading days. It's kind of found resistance here. It hits it, goes down, and then it's been creeping up, and it went all the way up to that resistance. And yesterday I wasn't sure what's going to happen. It could have gone higher. We could have gone a lot higher. And this chart here essentially mimics the Nasdaq or the S&P, because it's a very high beta stock, so it's going to trade along with those. So what we've got here is a very bearish print. You can look at the length of the candle, see how long the candle is. It goes from, let me just pull up a 1 month chart here. You can see the length of the candle. The candle is just that one trading day from open to close. You can see it opened up the price opened up here in the morning and it traded all the way down to 95, where the low was. Oh, sorry, the low was actually 94.86, and it closed about the low. You can see that candle, produced a 2% drop. And if you look at when the crash, if you want to call it, well, I wouldn't call it a crash, but this latest correction where we had this almost flash crash, this kind of flash crash the other day, it traded down about the same. Actually, it traded down more. So what that tells me is that there's a lot more that it could go down, and that's why I'm short. I shorted expecting it to drop actually the other day, and still hung in there. So I usually don't short or trade, for that matter, stocks that are mega caps or large cap names, because there's not much volatility. You know, it's gonna, like, Intel is gonna move 1% a day. If you're lucky, if you're so you're in Microsoft, or those are not what I want to do as a retail trader. I want to trade something that's going to move 5% or more a day, and I'll go through how I select stocks like that in later videos and the kind of software I use. But as far as Under Armour goes, I'm very happy with my short position right now. And unlike Netflix, I probably, once I get a gain, if I do get a gain here, I'll probably sell half of the position, half or 3/4, to lock in the profit, and then let the rest run. Because I always lock in profit when I get it. As far as when I'm trading, investing's a different matter. So that's what I'm gonna do with Under Armour here. It could very well go down to 80s. We saw we saw Netflix drop off a cliff, and I expect this chart to mimic Netflix. It just looks like a Netflix chart, just a little bit lagging. And the other thing I want to look at is I want to look at oil, because I do follow crude oil, especially when there's a trade. I've also been watching natural gas. Natural gas has a very interesting setup. It's formed a triangle, but I don't want to talk about that right now. I just want to pull up a chart of oil, crude oil, futures contract to CL. Most people call it CL, if you want to call it crude oil or whatever. And we've got a 6-month of oil, and you can see the bottom. I don't want to call it a long-term bottom, because picking bottoms on crude will make you broke. But the bottom it's put in right now, it looked like a pretty good bottom, and it's consolidated. Let's pull up a 1 month. On the 1 month chart, we can see that it's consolidated in this flag. At first it looks like a bear flag or a pennant. A pennant's just it's a kind of choppier flag, and I've gotten good at recognizing these over the years. And you can see it's actually a triangle consolidation, which is one of my favorite consolidations. And right here on this hammer candle, see the hammer, it looks like a hammer. That's a very bullish candle, although it was negative on the day that day, and it printed below the open, so that's bad, or bearish. And I wasn't sure which way it was going to go, so I decided I want to just watch it for a couple days and see how it reacts around that tip of the triangle. And you can see it's a lot lower today. We've got a big plunge in crude oil or rather yesterday. It's late evening, early morning here, and it's engulfed this candle earlier. It's very bearish, and this move is enough to show me that it's proven itself to go lower. So it wants to go lower, and I assume will very soon here. It could go up again a little bit and then down, but I want to short this on a breakdown. A breakdown's a lower low, or a break of the support when price goes below. In this case, it would go below 44.05, and that happens to be about the low of the other day. So there's some very serious support at 44, around 44, and if it starts hitting the 43s, statistically, or basically just simple technical analysis, it's going to go lower. So I want to short that there. And there's other ways to play that. You could play it with ETFs. The ticker symbol's SCO. It's a double short. Or you could even go into the the stocks themselves. There's exploration stocks. There's all kinds of oil stocks that will trade in line with crude. I'd rather just trade the vehicle itself. I mean, I like ETFs, so I'll probably be long SCO. S is in Sam, C is in cat, O is in octopus. I'll be long that probably tomorrow or the next day if we do get that breakdown that I've been looking for. And I talked about natural gas, so let's just look at natural gas real quick. I'll put in the actual futures spot price, which is because ETFs have a lag. The ETFs have a decay because of the contracts. So ETFs aren't the purest vehicle for any commodity or future. So we've got this triangle. You can kind of see it here. I'll draw it up real quick. We've got this triangle going, and this software is stockcharts.com. Well, it's actually a website. It's a free website. I use stockfetcher.com and I use stockcharts.com along with my MedVed Trader. I use a MedVed Trader software with DT and IQ feed for the data feed. And MedVed's a lot like Quote Tracker was. So I like stock charts a lot. Just the way the candles look. The candles are perfect, and the backdrop is great, and the volume. It's like visually, it's what I want to see in a chart. So we've got the top of this triangle that I'm drawing a line, this blue line to, and it's a perfect bottom on the triangle. The support is textbook, the trend line support on this trend line, and the triangle broke. Price broke below this triangle, which is a very good indicator that it's going to go lower. But you can see it's been pretty stubborn right here, and it's actually formed a new little trading range. And trading ranges this small are very good indicators of the next price movement when it breaks below or above. So I'm just watching this. I'm watching this as important as the triangle is. So, we'll see what it does. I've traded natural gas twice this year. I traded it once for a gain, and I might have gotten lucky on that one because it's not the easiest vehicle to trade, and I usually wouldn't be looking at it except with the exception of this triangle. It's textbook right here. It's going to be a good trade as soon as we figure out the direction that it's going off of it. So that's what I want to touch on tonight, and I'm signing off here. This is Mark with stockpursuit.com. Have a great night, and may all your fills be complete.